Our number one stock pick, Nebius, just reported Q4 earnings. And although it did miss on both revenue and earnings estimates, it actually ended the day green. And I'm going to unpack everything here in this video and explain to you why I'm so bullish on this stock over the coming months and years. And as you know, on this channel, we are growing a Robinhood account to $1 million, and we're doing it through two different strategies. One is the 1 million challenge account, where we're a buyer of options and shares, and then a selling options portfolio where we're a buyer of shares but only selling options. And as of February 12th, we did close at 21K and 32K in both of these accounts. You can see here on the week on the selling options portfolio, we're actually up on the week. And overall in this account, 1 year, we are up $420 since we started it back on November 26th. Now, before I get into Nebius's earnings, I'm just going to give you a quick rundown of the portfolio. And you can see for the selling options portfolio, we have all of these open cash secured puts as well as covered calls on a few of these stocks. And then these are all the shares that we do own. Now, funny enough, we are green in this account, but we're actually down on all the share positions in this account. If you look at Nebius, we have like a $98 cost basis. We're down 9%, $906, almost 10%. We're down on Snap. This was a stock that just got destroyed. It's dead money at this point. We're just going to hold these shares, see what comes from it. But software is having a pretty rough time, but we're down 36% there, down 17% on EOSE Energy. Velo, we're down 14%. Bridger Aerospace, 8%. Joby Aviation, almost 4%. So you can see we're down on every single one of these stocks, but we're actually green in the portfolio. And the way that we do this is by really selling options and lowering our cost basis. But if you want to learn more about this, you can check the second link in the description below, where I talk about the Hitchhiker's Guide to Selling Options. And that's just really all the basics on how you would actually manage and do something like this. And that way you can accumulate more of quality companies for less. And then over time, as long as the price goes up, you will make and juice your returns essentially. And then the $1 million challenge account, we do post all of our entries and exits in here for free, as well as there's just a good group of guys discussing stocks in there. So if you'd like to learn more, just check out the first link in the description below. But on this account, for the past year, we're still up 17.6%. It's been pretty rough since the apocalypse happened back in October, and we are down quite a bit from our all-time highs here around 39K. But we're a buyer of options here, so we did take on more leverage, and for that reason, we're down from October. But nonetheless, we're still up in the account. We probably could have just saved the headache by buying SPY. But nonetheless, these are the different companies that we own in this account. Nebius is going to become also, I'm just super bullish on this stock. I own a ton. I'm probably like 85% across all accounts. Full ported into Nebius basically at this point. Bought some more today. But we're probably going to rotate out of some of these other stocks like Neo and Grab. We're okay on these. Like, we're still up on Neo and Grab shares. And it's just been like kind of sideways for a year now. So we're going to probably move some of this money out and try to put more into Nebius, T1 Energy, as well as EOSE. And then Zeta, they just been getting hammered because software is down, but they do own proprietary data on their customers. So I still think it's a pretty solid buy, but there's just sentiment is so bad and so negative right now that, you know, it's really hard to see any sort of sustained uptrend. And then T1 Energy, right? Like, our focus is shifting to energy infrastructure. And so solar is T1 Energy. EOSE is BESS, which is battery energy storage systems. And that really helps with the power demand for AI and building out all these data centers, all the infrastructure. But T1, it is finally starting to drop. We were trying to play some puts, but we just timed it wrong. Now it is dropping, hit around $6 today. I think it can drop a bit more. They do have earnings coming up. We'll see what happens there. And then we got some covered calls that we don't mind because some of these are actually in the money. We sold these in the initial run up, so we don't mind if the stock actually goes down. So that's kind of where we're at with the portfolios right now. I did add more Nebius shares as well as Nebius Leaps today in the challenge portfolio. We sold out of Upwork. And then, of course, the selling options. We're just going to be putting more and more money as much as we can, collecting premium along the way, and just dumping it all into Nebius, EOSE, and then potentially adding T1 into this portfolio as well. So things are doing okay in the public portfolios, but really let's just like hop right into earnings for Nebius, because this really blew my mind with like, I thought maybe there could be like some sort of big blockbuster deal headline that would move the stock up, and I was hoping for something like that. But what I got was much better, because they're just operating so efficiently and at scale and at lightning speed, which is just very difficult to do. It's not easy to build a data center, right? Like maybe it's a little easier to build just like a road or some random office building, but building a data center requires a lot of engineering, technical expertise. It's not something that you can just stand up on your own if you know construction, right? There's a lot that goes into it, and Nebius has the engineering talent and the construction partners to actually build these massive data centers at scale in such a short period of time. And that's why I'm so bullish. Like, this earnings was really the turning point for this company, the inflection point, because we actually had the capacity online in Q4 of 2025 to see what margins look like. And this company is executing on margins. So just kind of like running through this infographic here. First and foremost, they were guiding to $1.1 billion at the end of 2025, and they ended at exit ARR of 1.25 billion. So they exceeded their ARR despite being under on revenue as well as earnings, which the market doesn't really care about, because this company is all about the growth and the future potential, right? Next, they are still guiding. They reaffirmed $7 to $9 billion in ARR by the end of 2026. And I just took some notes here from X, as well as the transcript with the earnings call. And the CEO reiterated that guidance for 7 to 9 billion. And he said that he said that his conviction in this range has become stronger due to exceeding the high end of their 2025 ARR guidance. So they exited 2025 at a higher rate. So hopefully they can get closer to that $9 billion number rather than that 7. And that would be a massive, obviously that's a huge gap in total exit ARR for 2026. And that could be very bullish if things start to actually improve going into the year end. Kind of flipping back here and forth, we see that their contracted power guidance, people talked about power energy being the bottleneck. They did 2.5 gigawatts is what they were forecasting end of 2026. Now they increased that amount to 3 gigawatts, right? So them actually getting these PPA, these power purchase agreements in place with the different sites that they're looking to build in doesn't seem to be that much of an issue, right? In some cases, they're like a closed loop where they're not really making that much of an impact on, they're setting up their own power on site rather than connecting to the local grid, which has been a lot of the pushback that we've been seeing with certain states and counties that are against having data centers nearby that are going to increase the utility costs. So overall, very bullish. Doesn't seem like they're having any issue here. Obviously, like, there's capacity constraints around GPUs and things like that, but at least from getting power and building these data centers, it seems like they're on schedule. Looking at their footprint, right? Like, this is the most diversified neo cloud / hyperscaler that there is, right? They have all of these different existing sites, some owned, some co-locations, but in Israel, France, Amsterdam, UK, Finland, Iceland, Amsterdam's just their HQ. But then you got New Jersey, and then there's new sites with Missouri and Alabama. They own land there, and they're looking to build, at least what we know of today, a 1.2 gigawatt Independence, Missouri data center. That could be massive, because right now they have New Jersey. That's the Microsoft deal, a $19.4 billion 5-year contract, and that is only 350 megawatts. So if they secure something in Missouri, it could be a much, much larger hyperscaler deal, or maybe they're trying to build out their own capacity and then they would sell directly to the customer, and therefore see an even higher margin on their revenue that they're selling, right? Instead of going through a middleman with a hyperscaler like Microsoft or Meta, they could just sell capacity directly to their customer using their software. And that would be much, much higher margins. The next thing is 2 sites to 7 sites, and now they're saying 16 sites. I don't know how they're able to deploy all these engineers, construction, manage all these things at once, but they seem to be doing it very effectively. Up 540% year over year, 228 million revenue in the quarter. I think they're guiding to around 3.0 to 3.4 billion in actual revenue for next year, and then exit would be between 7 to 9 billion ARR. But you can see their margins are increasing 10, 19, 24, and they're forecasting guidance to be 40% adjusted EBITDA margins in all of 2026. So we're seeing that they're actually executing and delivering to the bottom line, whereas a lot of bears out there were saying that Nebius and all of these other neoclouds are just like bare metal providers, and they might have these big blockbuster headline deals, but they're not actually recognizing any bottom line. They're not making any money off of it. But you can see here they have $3.7 billion in cash, including $834 million in positive operating cash flow in Q4, positive adjusted EBITDA for the first time in Q4. And then, a couple different highlights here. They just made another acquisition for agentic search. And then the other big thing here is AV Ride. Like, their subsidiaries can be massive companies on their own, specifically AV Ride, which is a fully self-driving tech, as well as like food delivery robots. And they're partnered with Uber, and they actually launched their commercial robotaxi service in, I believe, Austin, somewhere in Texas in December. So we'll see if this starts to heat up as well. You got Tesla robotaxis, you got Waymo, and those are massive, massive valuations, over 100 billion each. And AV Ride potentially could also re-rate much higher if they continue to expand with Uber into other cities. And then ClickHouse, the valuation, we've been talking about this one, very bullish on ClickHouse. They only own about 27, 28% of it, but they re-rated higher. They raised money for $15 billion in January. So very bullish. Their investment is like 4.8 billion, I think, now in ClickHouse. So really, really positive earnings overall, despite them missing both revenue and earnings, which led to a sell-off in the morning. The stock dropped like 8% in the early session. I was buying shares, I was buying contracts, looking to play the upside, and then it ended up closing green. And I'll probably even buy some more later this week, depending how things develop. If it drops, I'm definitely buying more. But another highlight here was in Q3 we had the $25 million or 25 million share ATM dilution, and that facility was put in place and was kind of like an overhang on the stock. Like, if you look at the price after earnings and how it was trading relative to other neoclouds, it was not performing as well. You had, even CoreWeave like kind of bounced quite a bit, and then same thing with like Iran. It's not really down nearly as much. It didn't take out those more recent lows back in December. But nonetheless, we got some really positive news here. Despite them not touching it at all, they didn't use any of it. They said that they actually don't have any concrete plans to use it in the near future. The $3.7 billion in cash, their positive operating cash flow. They also made a comment that 60% of all the CapEx for 2026 will be financed by customer prepayments. So they're able to negotiate with these contracts to build out their own inventory with other people's money, and they don't have to actually go out into the market, the debt market, to actually finance any of it. They don't need any external financing. So very, very bullish that they're recognizing margin, positive cash flow, but then also the customers are prepaying for them to actually build all of it out. Sounds pretty good, right? You can build out your own inventory, and then just, it turns into a revenue stream for you, and you didn't really have to pay to build it all out. So that just goes to show like the technology that goes into building all of this out and how much demand there is. They're in a very good position. They have a lot of negotiating power with these contracts to negotiate these types of things and these structures that make it advantageous for them. So overall, very bullish. And if they ever do decide to tap the ATM, it could actually be accretive because they would be accelerating capacity and still maintain a healthy balance sheet. The big problem with like CoreWeave is they have a bunch of debt, toxic debt, and it's much harder for them to raise money. Whereas Nebius has kind of kept this like laser focus on margins and expanding efficiently, scaling up efficiently. And over time, that is going to pay a bunch of dividends for this stock. 100% of their customers use the software platform. That's like the software layer that a lot of the other neo clouds are missing, right? We don't know if Iren Energy, are they able to actually even run AI workloads? Like they're a Bitcoin miner. There's a lot of these Bitcoin miners that are switching over to AI compute, and we don't know if it's really proven that they can even do that. Plus, they don't own the software, which is where a lot of the margin is. So Nebius is kind of becoming like this hyperscaler in the making. A lot of people call it the AWS of AI. We're starting to see the early stages of that. Obviously, 40% EBITDA margins by 2026 would be huge. The Tavily acquisition with agentic AI search, this is just another asset for their software stack. And then contracts are getting longer and richer. So, they're probably going to have another hyperscaler deal with the Missouri location at some point, and that's going to be a massive re-rating, much, much higher on the stock. So a few little other highlights here. The Microsoft, the first tranche was delivered on time in November of 2025. That's why we exited the quarter with more ARR. Same thing with Meta. The capacity was fully delivered and now servicing. That's the $3 billion deal. So very bullish over there overall on the quarter. And then from like a construction standpoint of how quickly they're able to stand up these data centers, the CEO of Data One, Charles Benet, he's like really loud on LinkedIn and now even on Twitter. You should check him out. But he is like an advocate for Nebius, and he's incentivized to be that way, but he is just all over Twitter and LinkedIn bragging about how great the Nebius management team is, with actually being in partnership with them to build out the power shells, the power itself, everything that goes into actually building the outer shells, the cooling system, all of those things. And then actually the Nebius engineers come in and hook up all the GPUs. But nonetheless, they're able to deliver a full 350 megawatt in New Jersey, the Vineland location for Microsoft. That is going to be completed in November of 2026. They said they're on schedule to actually have that completed, 350 megawatts, and they switched the development. They actually changed how they were going to build it. It was like 5 to 6 buildings, and then they switched it to the first building, and then they combined all the other buildings into 2 massive double-decker buildings. So mid build out, they actually changed the design. And that shows that they were still able to change the design and complete it in 18 months, where a lot of these other data centers could take 18 to 36 months. And not only that, he's saying now that they could do a 400 megawatt power plant in 12 months, which is just insane, right? So they have the lightning fast execution to actually build all of these things out in such a short period of time for Nebius to actually reach those end of year guidance and then go into hyper growth into 2027. So overall, very, very solid earnings. I'm more bullish than ever. Obviously, like Agents just released, Anthropic just did like another fundraising round, 38 billion at a 380 billion dollar valuation. So overall, all the capex that's coming from all the Mag 7s who are like doubling capex for 2026 in the hundreds to $200 billion range, all of that money is going to be raining down on companies like Nebius, and they're actually able to generate a margin, a return on their investment. So very, very bullish here. Just looking at the stock price, I mean, it's kind of in this big consolidation, falling wedge pattern. It is trading at $22 billion market cap roughly. If you compare this to like CoreWeave, which is trading at 48 billion right now, They have a $56 billion backlog, which is just like the total of their customer contracts. Like Nebius has 22.4 billion with Microsoft and Meta over 5 years, right? So they're trading kind of like 1-to-1, whereas like I said with CoreWeave, it was 48 billion to 56 billion backlog. The difference here, though, is that Nebius has ClickHouse, Avirai, Toloka, Triple 10. It has those other subsidiary valuations that are around like $8 billion. And then that doesn't even count. Does that even, I don't know if that even counts cash. But nonetheless, like the core business, the actual like data center AI compute side of the business is only around like $15 billion, we'll say, with 22.4 billion in backlog. So right off the rip, that's like 63% versus this is around like 85%, right? So like this is, I could do the math, but it's probably around like 35% that CoreWeave's trading at a premium relative to, as a percentage of backlog relative to Nebius. And at a 35% increase around $90, that would put the stock price back up near 130. That's just assuming that they don't have anything else coming to them. But CoreWeave, I don't even think that they're actually recognizing quite the level of margins that Nebius is, and as well as their balance sheet, right? Like CoreWeave has a lot of problems with their balance sheet. So Nebius should be trading at an even higher percentage of backlog or just a higher multiple, a higher valuation relative to CoreWeave. And they're growing at an insane clip and have really all the tailwinds behind them in the macro environment. So I'm definitely a very strong bull here on Nebius. Just looking at like the overall, the price structure here, you can see that it's come down quite a bit. It's in this massive consolidation pattern. There's a low volume shelf here and it keeps bouncing out of that area, right? So right around this $84 to $74 range, it's been bouncing out of there and acting as support. If you look at it on the longer term, this more previous high and this more previous high at $76, it's holding that area, right? You have a breakout and then it comes back down. As long as it keeps holding this area, eventually it'll probably break out of this consolidation pattern and head back towards all-time highs at $140. Now there is a dilution convertible note level right around $139. That area is going to act as resistance. So if you're a seller of options, right, you own the shares, you do a buy and write strategy like I am, then you'd be looking to use this 140 area as like a place where you would like to sell options, because this is going to have some downward pressure on it if it ever gets back up there. And so that's really what I'm doing right now. I'm buying 100 shares here, or I'm selling cash secured puts in this 90 to 95 range. At some point, it's going to probably drift higher and break out. We'll see what happens with the market. Right now, the market is like all over the place. Like you had this massive pull down today in the SPY as well as QQQ. We have CPI data tomorrow. There's still like a lot of uncertainty. There's a lot of rotation going on. You see things like staples starting to rally to the upside. People are moving into defensives, right? People thought that AI was very transformative over the last few years and all those stocks went up and to the right. Now they're saying it's very destructive, and you're seeing all this software just like dumping, right? Like you have Salesforce, you have Figma, like all of these software companies. Like AI can just replicate all of them. If AI can replicate all of them, then why should we own Figma, Adobe, Salesforce? All these companies are dying in the recent weeks. But if that's actually true, under the assumption that AI is going to replace all software, well, how does AI even exist? Well, it's through companies like Nebius that actually have to build the infrastructure, or companies like T1 Energy or EOSE that actually are the energy that are needed to actually run the compute, run these data centers. Well, then why are those stocks trading lower, right? So it's just kind of getting caught up in all the margin calls. You even saw like silver and gold, those sold off today quite a bit. Like I think silver was down over 10%, but I'm still very, very bullish on the overall economy. we saw jobs and unemployment, it's still sitting around 4.3%, 4.5%. That's pretty normal in the grand scheme of the market. But like I said, they're going to end up probably lowering rates. You got trueflation going lower. I think inflation tomorrow, we'll see what happens. If it runs a little hot, the market will sell. If it's a little low, then the market's going to rally because the odds of a rate cut will increase for March. And maybe, we'll have a few more rate cuts this year, which are all bullish for asset prices. So there's a lot going for it right now, but in the near term, it can definitely stay within this range. I do, obviously, from a technical level, like to buy it on this lower end of the trend line or anywhere near 76, since this is a key support area that has held in the past. But yeah, pretty much anywhere in this range in the short term, I'm not going to be upset about if it's up or down. This is like a $30, $40 range. It's really not that big of a deal for me because in the long run, standing at a $22 billion market cap, I think this stock can easily overtake CoreWeave, which is at 48 billion. So a more than a 2x potential for this year on this stock, as long as it continues to execute. They're kind of in their own lane, right? Like a company that's recognizing 40% margins on $9 billion in ARR growing at 500 to 800% year over year is just mind boggling for a company with this scale and everything that they're doing. So that's really it for this video. I'm more bullish than ever. Make sure you guys join the Discord. I'll be posting a lot more really exciting things for this year, and I'll see you in the next video, guys. Peace.